Hi everyone. Okay, so what we're going to have a look at today is the flexible budget, all right? And we're going to look at where it comes up in the paper and how it can be brought into several different questions on the paper. And we need to be really careful with that, okay? So what I'm going to do is I'm going to have a look at the way it's come up, and then I'm going to do one full question, which is so as you have the full workings on it and you know exactly what has to happen. So if you look in the 2024 paper, all right, so in section 3 on the 2024 paper, we can see what way it came up, all right? So we can see that it actually came up as a flexible budget in its own right, but then they brought in a marginal costing part into it, okay? So if you look in part 4 here, based on your calculations in part 3, calculate the break-even point and the margin of safety at 85% activity level for Royston, and then give an example of the term controllable costs. So a nice little theory question in there. So what you need to be really careful of is when you read through your paper before we pick your questions, particularly between 8 and 9, okay? It says flexible budgets here and stock valuation, but then there is a little piece of marginal costing put into it, all right? So that was in 2024. Then in question 8, sorry, this is the market scheme there. When you look on then to 2018, you have a full flexible budget coming up in question 9. But as you read down through it, so very similar to what we've seen before with flexibles, all right? So you prepare your flexible budget for 95% using marginal costing principles and show the contribution, all good. And then assume that Conlon Limited is currently operating at 100% capacity and is considering 2 capital expenditure options costing 8,000 each. So again, you're back into sensitivity analysis here, all right? So you're looking at how do we go about doing this? How do we carry out the analysis for option 1 and option 2, and that's basically marginal costing. So you can see where they've mixed the two of them in. So anybody who's kind of looking at predictions or anything like that, they might say, oh, well, look, did a marginal costing come up last year or did a flexible come up? But you just need to be careful that it could be there again, all right? So I wouldn't rule it out. And it's like flexible is one that can be put into like a part of a short question in question 8, or it couldn't be a standalone question, all right, as you see here in question 9. But the trend now is to have some marginal element in there, all right? So we do need to keep an eye on that. And then, just that's the scheme there. And then as we move on again, we can see it crops up again though. In 2008, we can see that we have section 3, question 8, part B. So that's what I mean by it comes up as a small part of a question 8. So you could have had absorption costing in there, you could have had stock valuation in there as well, under and over absorption, a little product costing thrown in. So you just need to be careful that you're not thinking that it can only be a question 9, or it will definitely be a standalone question, because that's not the case. So the one that I'm going to look at today to work through from, I suppose, the very beginning with you is the 2006 question. So when we look at the 2006 question on this, we just need to be really careful that we are fully aware of what the high-low method is, that we know how to go down through that step by step, and then that we can prepare a flexible budget, and then we can restate it using marginal costing principles. And key thing here is showing your contribution. And then the theory that goes with these, so adverse variance, state why the variances may arise in direct material costs. And just to be careful when you're answering a theory question like that, you must refer to manufacturing expenses here, okay? And then explain with examples your controllable and uncontrollable costs. So we're going to look at the theory part of that as well, just to make sure we're okay. We might even look at that now, actually. So if we look at part B there, they're asking us, what is an adverse variance? All right, so it's where our actual costs exceed our budgeted costs, an adverse variance in direct material costs. So you can see it there, direct material costs. We're not talking about an adverse variance in like light and heat or something like that. It's your direct material cost. You're referring to the manufacturing cost. May arise if the purchase price of materials is higher than expected, or if the quantities of materials used are higher than expected. So again, you're referring back to the direct materials in that. So your controllable costs then are costs that can be controlled by the manager of a cost center. So that's the first part. You need to define what it is. And then she or he will make the decision about the amount of the cost, or if the cost should be incurred and can be held responsible for variances in these costs. But the key thing then, for example, all variable costs are controllable. And I would go as far as putting in an example of a variable cost there. So I put in a manufacturing context, what could we look at there? So all we can control really is our direct materials, our direct labor. We can shop around to get direct materials cheaper. We can move our production to get our labor cheaper. So things like that, that's what you're watching out for there, that you're referring back to figures in the question and that are related to a manufacturing cost in this case. So uncontrollable costs then, costs over which the manager of a cost center has no control. The easiest example for us to use there are rates to our local authority, because we don't control those. They are set, they are externally set, absolutely out of the control of the manager. They can't be held accountable for what happens there. So things like that, that's what we need to keep an eye on to make sure that we are hitting the key points on these all the time. So going back to this full question then, and I'll go through it nice and slowly to make sure everything's all right. So you start off and you have your flexible budget. McGinley manufactures a component for the motor industry. The following flexible budgets have already been prepared for 50%, 75%, and 85% of the plant capacity. Now, we're only ever going to be using 2 of these. We don't need to use all 3. So that's the first thing. So when you go to set this up, it's never going to be a case that we're going to use all 3, the 50, the 75, and the 85. So from the outset, I think the easiest for us to do is say, here's my lowest and here's my highest. And that's how we end up using the high-low method. And then classify the above costs into fixed and variable and mixed costs. Now, a really common thing here is for you to mark this on your paper and then not put it into your solution. A really simple set of marks to pick up, but you must actually state it, okay? So when we go to put this in then, we're coming back and we're saying, right, what has to be done here? So part A of this question, so this is the 2006 question, and we're just looking at part A here and we're saying, right, what needs to go in here? I'll just make that visible for you. Okay, so that should be a bit better on your screen now. So 2006, part A, they're asking us to analyze these costs. And it's quite simple, but you just don't want to lose the marks, okay? They're easy marks, so let's make sure that we get them, okay? So let's go back to it. So our direct materials are going to be variable, our direct wages are going to be variable. The production overheads and the other overheads will be mixed. Now, if you get confused on that, just look at part 2 and part 3. They're asking you to separate them into fixed and variable, therefore they must be mixed. And then your admin is fixed because it doesn't change regardless of the level of output. It's always 28,000, 28,000, 28,000. So we just need to get those jotted down first. So that's what we're going to do. We're coming back and we're saying, right, direct materials. Direct labor. So direct wages, we'll use the language they're using. So they are variable. And you need to state that, okay? It seems a bit silly, but we want to pick up these easy marks. And don't forget, 4 marks is a % on the paper, so be really careful with that, that you don't throw away any of these easy marks. Then we have our production overheads and our other overheads. So our production coming in there. And our other overheads. Both mixed. And then admin is going to be the fixed. And remember, fixed because it doesn't change, regardless of the number of units produced and sold, it never changes. So you're straight into part B then. So they should be nice handy marks to pick up. And there shouldn't be any major concern as you're going through those. So into part B then, what's it actually looking for? So we have, sorry, part 2 I should say. So separate production overheads into fixed and variable elements. Okay, so what we use here is the high-low method. So we need to be really careful on that we know what method we have to use. So I would have that on a flashcard. I'd have flexible budgets, high-low method. All right, and then before you go into the exam, you just glance through that. You're not trying to have a flashcard that's completely overloaded. It's just for you to flick through and go, yep, I know what that is, I know what that is, just before you go in. Right, so we're going to take the highest number of units and the lowest number. So the lowest number of units, 10,000, highest number, 17, and the relevant cost. And that's really important. And get into the habit of highlighting that so as you have the relevant cost. So we're saying production overhead 73, and then we have our 122. So your setup on this, if you're consistent in your setup, even muscle memory alone, you'll just go back and you'll reproduce that. You won't even think about it. So let's try and get that now. So we're taking our production overheads. Sorry, I should change that. That's part 1. And this is part 2. So high-low method, first of all. You're literally taking the highest number of units, its corresponding cost, the lowest number of units, its corresponding cost, and then you're going to find out what the change is. All right, so we're going to go through that nice and slowly now. So this is for our production overhead first. So production overhead, and all we're doing is setting it up, okay? So we're going to go highest, lowest, change. So highest, lowest, and the change between the highest and the lowest. That's what's actually happening here. We're going to put in the units and we're going to put in the cost associated with it. So the highest number of units, go back to your question, take your highest number of units, 17. Lowest number of units, 10,000. And all we're doing is we're just getting the difference between those two. So we're saying 17 minus 10. So there's a difference of 7,000 units. So the difference in the cost then, so we had 122 and 73. Okay, so our difference here, when we go to, just make that fit for you. When we look at the difference in the number of units and the difference in the cost. So the change in my cost is 49,000. So think about that for a second. You produce 7,000 units more and your cost goes up by 49,000. So you're basically saying, what's the change per unit? That's what your variable cost is. So the change per unit, the variable cost, all you're doing is taking the change in cost and dividing it by the change in units. That's basically the formula we're using there. Now, we don't need to write that out all the time. This is just for you in your notes when you're getting used to it, okay? That's what you're doing there. To get that value, you're saying change in cost divided by the change in units. So over to the side of your page, we're always going to put in our variable cost per unit. So you come along then and you're saying, right, 49,000, and it's divided by 7,000 in this case. So we get a nice handy little figure there. Now, make sure you put in your euro sign on it and make sure that you have everything in place for these, okay? So we're coming along and we're just saying the change there is going to be €7 per unit. Now you will do that on a calculator, okay? Make sure all of these simple calculations are done on a calculator. You don't want to throw away marks. So now we have our variable cost per unit, all right? So what we need to do now is we need to figure out what the fixed part is. So to calculate your fixed cost, we know that the total cost is equal to my variable cost plus my fixed cost. Never changes. That's what it's going to be, all right? So all we're doing here is we're coming along and we're saying, right, well, what do I need to do then? Like, how am I going to figure out what this fixed part is? So if you know what your total cost is, and you can figure out what the variable cost is, because you know the number of units, you're just going to multiply it by 7. And if you subtract it, then you're going to end up with the fixed part. So to get your fixed cost, you're going to say total cost minus the variable. Right? But obviously we need to have a nice way of presenting that to our examiner so they can see it really clearly. So this is what we do. We come along and we say total cost and we say variable cost, because we are going to be able to work that out. When we subtract them, we're going to end up with our fixed cost. So all we're doing is just putting it into a table form. That's it. So what we're going to do is we have to do it for 2 sets of units so as we can verify that our answer is correct. Okay, so we're going to come along and we're going to go for 17,000 units. And we're going to take it for 10,000 units as well. So we'll come along, and all we're saying is the total cost when we had 17,000 units was 122,000. When I had 10,000 units, it was 73,000. Now the variable cost per unit, okay? So I'm just going to put in another column here just so you can see it. I'm going to move these over a little bit. So as I kind of have a workings column as such, all right? So just moving them over. I'll tidy this up a little bit for you. So we can work out our variable cost per unit. So all we need to do is come along and say, right, my variable cost was €7 per unit. So 17,000 times 7. I'm just showing it in blue because it's a working, all right? And you'll start to see my notes. If it's a calculation that I'm doing, I'll put it in blue so as you can see, if you're looking back on the file later on, you'll be able to see, oh yeah, that was something that we calculated ourselves. So we're taking our 17,000 and we're multiplying by 7. So 119,000 for the variable cost. We're going to do the same here, okay? So we're coming along and we're just putting in, and we're saying, right, 10,000 units, and then multiplied by the 7. So again, do not do this in your head, please, all right? So you're going to go 10,000 units and then multiply by 7. So that's our 70,000 there. So if we have done this properly and our variable cost per unit was correct, our fixed costs will come out as the same figure. So 3,000 and 3,000 here, okay? So now we know our variable cost per unit, €7 per unit, our fixed cost, 3,000, okay? Now we want to present that. So variable cost, so we're coming along, and all we're saying there is just €7 per unit. And then fixed. Remember, you're making your examiner's life easy here. You just want your examiner to see it and say, brilliant. Just give you the full marks and move on. And that's what they will do, okay? They're not going to spend ages going back through everything. If you have the correct answer, it's just tick, move on, all right? So there's our two answers. So let's just recap on that, and then we'll do the other overheads again, just to make sure we're okay. And remember, it's your consistency on how you lay this out. That's the key on this one. The system behind it, the method is grand. It'll be nice and simple, but what you have to do is you have to get really good at taking it nice and slowly initially, getting it all done perfectly, and then you're able to apply for marginal costing questions, for the short part in question 8, anything like that. So it becomes a really handy little question then for you to gain top marks in. So let's just look, okay? We're coming along. We got our variable cost per unit. How did we do that? We got the difference. So the high-low method, we got the difference between the highest and the lowest. So 17,000 minus the 10,000 gave me 7,000, a change in units of 7,000. What was the corresponding change in cost? 49,000. Simple. So we have our 49,000 there. All we're doing then is we're getting the rate of change. So if the change in cost is 49,000 and the change in units is 7,000, that meant it was €7 per unit. There's my variable cost per unit. Perfect, done. We come down then and we're trying to figure out what the fixed cost is. So the total cost is equal to variable cost plus fixed cost. Therefore, fixed cost is equal to your total cost minus the variable element. And we just need to set that up in a table, basically. So we're coming along and we're saying 17,000 units, 10,000 units, put in the relevant cost, 122 and 73,000. Your variable cost then, 17,000 by 7. Now, where are we getting that from? The number of units multiplied by the variable cost per unit. That's all we're saying every single time. So that was 119. Then I had 10,000 units, so I'm putting 10,000 multiplied by the variable cost per unit, which is €7 per unit. So I have 3,000 there. And then you're making your examiner's life easy. You're coming along and you're saying, right, here's the variable cost per unit, here's the fixed cost per unit. They'll just go tick, move on, and then they're much happier with you when it comes to a theory question. Might be a little bit lenient if they have to be. All right, fingers crossed. So that's part 2. That's our production overhead separated into fixed and variable. Then we have to separate our other overhead costs into fixed and variable elements. So if you're trying this as we're going along through the class today, absolutely brilliant. Just all I'd say to you is try it and just keep an eye back up on the screen as I'm going through it. And at least that way then you'll have tried it and you can go, oh yeah, no, that's where I need to tweak it there. That's where I'm going wrong, or my layout is slightly wrong there. So all those little things, just I'll always give you the question that we're going to do, and then if you're working ahead, absolutely brilliant, but just glance up every now and then, just like you would in class. Just glance up and just check, yeah, I'm on track there. Okay, so we're going to take the other overhead costs in, and we're going to change these. Now, obviously you can't rub out your highlighter, but I will do here just to make it clear for you. So the other overhead costs, 39 is your lowest, 60 is your highest, okay? So we have them marked. So we come along then and, right, our setup again, it's going to be the exact same. So we're going to say, right, part 3 this time. And it's our other overheads. Just to recall like what an overhead is. So, you know, your light and heat, your insurance, they're the overheads that the business has. And they're in addition, I suppose, to the direct materials, direct labor, things like that, okay? Now remember that crops up in manufacturing accounts as well. Try and link them all, makes your life so much easier. So if you were in a manufacturing account, you know the way you have your direct costs, then you have your factory overheads, that section. So link it that way, and you'll be familiar with the types of figures then that are going to be asked in terms of theory and stuff like that. So it's all about efficiency, trying to link them all in. If you try and learn the theory as separate for every single topic, it'll just completely blow your mind. So what you need to do is kind of think of it as these are all linked, and it's to find those links and kind of forge them together. That's the H1 student. That's what they're able to do. They're really efficient in what they're doing. They're not spending hours and hours and hours learning off theory. What they're doing is they're going, I do this topic, I link the theory in, I do this topic, oh yeah, I can see where the overlap is there. And do the same thing with your workings for the financial section as well. Okay, so let's go back to this. So our other overheads, all right? Now, I know when you're in class, you're probably constantly looking back and you're going, right, what did I do here? What did I do here? And sometimes that's good. You have to do that at the start. But sometimes then it can just be like, when do you ever stop looking back? So let's just think about this for a second before we go back up on the screen. Our other overheads, we're going to separate them into fixed and variable. How do I do that? I use what's known as the high-low method. So in order to use the high-low method, I need to know the highest number of units, the lowest number of units, and the change in the cost. So that's what I'm going to do. I'm going to take the highest, the lowest, and I'm going to get the change. Okay. So the highest, the lowest, and I'm going to get the change. What am I getting the highest of? The units, and then the total cost, or the relevant cost, the corresponding cost. So this time it's other overheads. And then just go back up and check. Is that what we did? So we have highest, lowest, change, units, and the total cost, or the cost, okay? And it's for our other overheads this time. So the nice thing about this is your highest number of units is still going to be 17, your lowest is still going to be 10, and your change is going to be 7,000. So you just need to be careful that you pick out the correct cost, okay? So go back and take your costs. So it's 60,000 and 39,000. And all we're doing is coming back and we're saying, right, 60 minus 39, we have it here. So a change of 21,000, okay? Now think about what we did next. We tried to get the variable cost per unit. So variable cost per unit, for every 1 unit I increased, what happened to the cost, okay? So we can see that the total cost increased by 21,000 when the total units increased by 7,000. So it's going to be the change in cost all over the change in units. So that's what I would have in a flashcard, and just have a little reminder, this is what I did. This is how I calculate my variable cost per unit. So 21,000, and it's all over your 7,000. So again, you have it nicely set up for yourself then. So it's coming in at €3 per unit. What did I have to do next? I had to figure out what the fixed element was. So I know that my fixed costs minus my fixed costs are equal to my total cost minus the variable cost. So how am I going to set that up? I'm going to need my total on the left-hand side. I'm going to need my variable and that's going to give me the fixed. So again, if I was you on a simple flashcard, I just have a little sample of this table drawn out, just with blanks in it, and you're going, what am I doing here? So it's highest units, so 17,000 units, lowest units, 10,000, and then the relevant cost. Just going to move that over. So what was my total cost? So when it was 17,000, I had my 60,000 going in there, and I had my 39,000 for 10. How am I going to get the variable then? So what did we do? We multiplied the total number of units, so 17,000 units, by the variable cost per unit, which we had just worked out to be 3. So 17,000, the number of units, multiplied by the variable cost per unit, which I know is 3. So all I'm doing is I'm coming along and I'm saying 17 times 3. So I have it there. How am I going to work it on this part? I'm going to take my total units, 10,000 multiplied by 3. Now obviously if you're under time pressure, you're not going to be putting in that little adjustment part there. But if you have the time and if you train yourself to do it, it's good to have it there, and then you're not going to make any mistakes later on. So now I want to work out what is the fixed element here. So 60,000 minus 51 is 9, and then my 39,000 minus 30,000 is 9 as well. So we know, perfect, we have it right. So variable cost, just my €3 per unit. So that's all I'm doing, just coming along, €3 per unit, and then fixed cost. So 9,000. And that's it. That's all you want to show. And you have that done for part 2 and 3 now. And you have a nice method that you can follow through at any stage. Again, as I was saying, on a little flashcard, I would have that gone in, and then before you go into an exam, you're just leafing through those flashcards, having a quick look at what's on them. Okay, part 4 then. So what are they looking for here? So if we go back, they're asking us to prepare a flexible budget for 95% activity level. So there's a couple of things that we need to do here. It seems like a really straightforward thing, and it is fairly straightforward, but there's a couple of things we need to do in advance, okay? So the first thing I would say is get your direct materials per unit. Get your labor per unit, or I think it's wages they use here. Okay, that would be my first thing I would do. How are you going to do that? And be consistent with how you do this all the time. I would take my lowest number of units and I would divide it into the direct materials and into my direct wages. Okay, regardless of what level of units you take, you're going to get the same answer. So if you take 140,000 divided by 10, all right, you're going to get 14. If you take 210,000 and you divide it by 15, you're going to get 14. Take your 238 divided by 17, you're going to get 14. So just pick one of them that you always use. I think that's the handiest thing to do. So you know you're always going to go to this first column. You're going to take your 140,000 and you're going to divide it by the relevant number of units, 10,000. Don't overcomplicate it. Just keep it nice and simple for yourself. So that's €14 per unit. Take your wages figure then. That's 110,000 and you're going to divide it by 10. €10,000 I should say. So €11 per unit. So now you have your variable cost per unit for direct materials and your direct wages. And there's only a variable element to it, so you have that part done. Now, they're asking us to state this for 95% level of activity, okay? At the minute, they've given us a 50, a 75, and an 85. So again, be consistent on this. If you want to get 95% activity, and actually, I suppose I should just explain what we mean by that. When you have a factory, okay, there's a certain amount you are going to be able to produce. There's a capacity, okay? You can only produce a certain amount in the factory. And that could be due to space, it could be due to the number of machines that are in there. There's kind of factors that are going to limit what you can actually produce. So all we're saying here is that at the minute, when we produce at 50% activity, we're producing 10,000 units. So I think the easiest way for us to do this is take your first one. So 50% is equal to 10,000 units. Find out what 100% would be. So if you were to take 100%, you're coming along and you're saying, right, 10,000 divided by 0.5. So 20,000 is 100%. And then we want 95% activity. So we're just saying 95%, take the 20,000 multiplied by 0.95. So we know 19,000 units is what we're after. That's what we want to work with, okay? So from here on in, that's the key figure. So that 19,000. So maybe underline that for yourselves in the exam so as you know. Don't highlight it though, because the highlighter won't come out when it's scanned. All right. Well, it can, but sometimes it doesn't read properly. So just underline it for yourself. Avoid highlighting anything in the exam actually, because it may not come out when they scan it. So 95% activity. So basically all we're going to do on this part, right, is they're asking us to prepare a flexible budget for 95% activity. So we're going to do this, but at 95%, all right? So we're going to have our direct materials, direct wages, production overheads, other overhead costs, and our admin expenses, and we're going to produce that at 95%, so for 19,000 units. Later on then, they're going to ask us to restate using marginal costing principles and show the contribution. And again, we can do that as well. There's no issue with that. So 95% activity, little title on it. And a little reminder for ourselves, 19,000 units. So we're going to start off, and the first thing we're going to put in is our direct materials. So take our 19,000 and multiply it by 14. And you're showing your examiner this. You're showing them the working, how you got it, okay? Our direct wages, we're going to take our 19,000 and we're going to multiply it by 11. We're going to move into our production overheads. And we're going to do our variable first. So the variable element of that, so back up in your question, we could see that the variable element, and make sure we're taking the correct one, is €7 per unit with a fixed of 3. So €7 per unit, so 19,000 times 7. And then the fixed is 3. Just putting that out as a total then, so you're 133 plus the 3. Other overheads, so there's going to be a variable and a fixed. And remember, you're keeping this consistent. You're laying it out the same way. So 19,000 by 3 is the variable element, just to show you where that's coming from. This one here, the €3 per unit. So you have your 19,000 times 3, and then the fixed element was just my 9,000, and just so you see where I'm taking it from, the 9 there. And again, you're just putting in the total there. And then your admin. So because the admin is fixed, it's going to stay at 28,000. So you now have your total cost. When you produce 19,000 units, this is the cost it's going to come in at. So you're going to take all of these and just add them together. Just highlighting them there so as you can see the figures that are being added. So 705. So that is your total cost. Now, in the question, they have to give us a percentage of the sales or of the cost of sales, or well, actually, that's the only, they didn't give you a percentage of the sales or the cost of sales. So they're telling us that the profit is budgeted to be 24% of sales. So just be careful on how you do that, okay? So the profit itself, now you don't have to show this part, but it's kind of handy to have it here because we can go straight into writing up the marginal statement then. If the profit is 24% of your sales, the sales is 100%, right? Therefore, the total cost was your 100 minus your 24. So the total cost is 76%. So it's nice to have this done. So you're going to come along and say, for your total cost, it's 705,000. That represents 76%. So to find out what the sales figure is, you take your total cost divided by 0.76. So the percentage that the cost is. So 0.76. So that's 927,632. Now this could be rounding automatically. I'll just check for you. You don't need to round it. You can give decimals there. So 2 decimals would be appropriate because it's money that we're dealing with. And then get your profit figure. So the 222,631.58. So that's going to be your profit figure. This is the answer though, 705. That's when you've restated at 19,000 units, okay? So that is your budget at 95% capacity. Part 5 then is where we have to restate using marginal principles, okay? So using marginal principles just means we have to go sales less variable cost, contribution less your fixed costs gives you your profit figure. That's what they mean by restate using marginal principles, okay? And this little line here, show the contribution. You will get marked down if that's not there, okay? So if the name isn't there in the figure, obviously you're going to lose marks, but the name is crucial as well. You have to have that in there. So when we go to do that then, we just need to be careful in how we're presenting that back. So we're going back here and we're saying, right, so, sorry, just got a title on it. So flexible budget, 95% activity level. So my first thing is my sales figure. So I'm coming along and I'm taking the sales figure from above. So I'm saying that sales figure is the 927631 less my variable costs. So because of the way we've set this up, we're just going to be able to go back up and say, right, direct materials 266, direct wages 209. The production overheads and the other overheads. And remember, you're taking the variable element there. So the variable element is 133 and 57. So that gives us our total for our variable. So again, the 4 are added. And all we're doing is subtracting then. And that gives us our contribution, and make sure that is labeled. So remember what contribution is. It's like a quasi-profit. It's the amount that we bring in by just producing and selling the product. It doesn't take into account any of our fixed costs. So it's just the expenses that are kind of directly linked to production that have come off it. So by buying and selling this product, we are bringing in 262,000 to the business. So that's the contribution to the business, if you want to think of it that way. Then we subtract our fixed costs. So again, all we're doing is coming along and we're listing our fixed costs. So we know admin are definitely going to be fixed. So the admin figure was 28,000. And then we're going to take the production overhead, the fixed element, and then the other overhead, the fixed element, okay? So go back to your production overheads. So you can see there, fixed element 3, and then for the other overhead, the fixed element was 9, okay? So I'm taking them from here. So the 3 and the 9, just so as we're clear on that. And they transfer into the final column. So we're subtracting that 40,000 and we're coming back in with our profit figure then, which should match what we had. Okay, so 222,631.58. So that's your profit figure going in there. So 221,631.58, and that's it. Okay, you have it restated now using marginal principles. Remember, when it says marginal principles, this is what it's looking for. Less the variable cost to show the contribution, and then less the fixed cost. That's the key on that. That's what we're after every time we do that. All right, so you have a full question done there, just to show you the marks, just because we have time before we move on to the other type, okay? Just to give you an idea of the breakdown on the marks and that, because I think that is important, okay? So you can see in part A, all right, for just stating variable, mixed, and fixed, you're getting 10 marks, all right? So that could be the difference between you and H1, all right? Because you're talking about over 2% of the paper there, all right? So every 4 marks is a percent. Just think of it that way. So for what we had, for just stating it, you're getting 10, all right? Coming down then and looking at your breakdown on the costs. So €7 per unit and 3,000, 6 and 6, okay? They've shown it for all three, but that's because it's a marking scheme, okay? So for an examiner, when we look back, we can see that that's, you could have taken either of those, okay? You didn't have to use all three, just 2. So there's your 6 marks. So you've 12 marks. So for having this, you're coming in at 12 marks. For your other overheads then, so the 3 and the 9, so 6 and 6. So again, nice and handy there to pick up those marks. In part 4 then, production overheads that require flexible, so they're coming along and they're just showing you what the breakdown is, and then at 95%. So we've come down along and you can see the total cost, 76% of sales. So 705. So if you look here, okay, what are you coming in at there? So 6 and 6, 18, 22 marks for part 4. And if you look at part 4, we've everything shown, we have a breakdown shown, and then the 705. There we can see it, that we're coming in at the full marks on that. Now, what they're not showing you here though is that by showing this adjustment, most likely that year on the marking scheme, there was going to be a mark and maybe 2 marks, you know, that sort of way. So it's not all or nothing. So if you feel that something has gone wrong, or, you know, when you get to the end of the question, you say, oh my God, it didn't actually match up. Don't let that throw you for other questions that you might do on the paper that day, because it isn't as clear cut as it seems sometimes in the marking schemes. There are, say, attempt marks going in, you know, or almost like partial credits that we talk about in maths, okay? And then our flexible budget here. So you can see that in this case, they have rounded, okay? They've taken it to the nearest euro, but absolutely nothing wrong with what you did there. Unless the question explicitly states that you have to go to the nearest euro, you're absolutely fine to leave it to 2 decimal places, because it's money you're dealing with, okay? And depending on the year, you can see the marking schemes will change. All right, if you look here, you can see the contribution going in. There's the mark for contribution, okay? No mark for the figure that year, but that's not to say that's going to change, okay? Or that it won't change. It could have a mark some year, all right? So that's a full flexible budget going through it, all right? Now, what I'm going to do, because we have time, is I want to go and have a look at the other style that can come up. Okay, so where we're going to be depending on this in a marginal costing question, all right? So if we go back and we look at the 2024, all right? We can see that they're going to ask us to separate them, so it's good practice for us. We can get it separated again, okay? And then based on your calculations in part 3, calculate the break-even point and the margin of safety. So it's a nice little recap before we go on to marginal costing. And then if we have a look in 2018, same idea again. They bring you into marginal costing questions here, all right? So this sensitivity analysis or cost volume profit analysis. And then if you look, they're giving you 2 options, and then prepare flexible budgets using marginal costing principles and showing contributions for both of these options. So there's a bit of time on that, okay? And then you have to advise the company on the best option. So just be careful with that when you're picking your question. Like that may have been more time consuming than people thought it was going to be. And then the last one then that we had mentioned within the 2008. So you could see that it was just a little part B just put in there, okay? So as years have gone by, maybe getting a little bit more demanding with the flexible budget. It's not as clear cut as just having this nice question 9 that you just do what we have just done, okay? So let's go and have a look. And I think we'll actually look at the one with option 1 and option 2. All right, so if we take the 2018 paper, all right, so we're going to separate them into production and overhead, separate the production overheads and the other overheads. That's fine, we'll get that done. And then prepare our flexible budget, and then assume that Conlon Limited is currently operating at 100% and is considering capital expenditure options costing 8,000 each as follows. So they've changed it. They've gone from 95% and then suddenly assume that we're operating at 100% capacity. So we need to bring everything back up to 100%. All right. So a nice bit going on there. So I'll just get this set up. If you want to bring up the 2018 question to have it there as well. And let's go and see how we get on with that. So 2018, all right. So the first little part on that, so they're saying to us, separate the production overheads and into fixed and variable, and separate the other overheads into fixed and variable. And then I'm not going to bother with the 95% activity. I'm just going to do the separation of these two, and then I'm going to go straight for the 100%, so as we can look at those marginal statements for option 1 and option 2, just to save us time. All right. So part A on this, and we're looking at part 1. So we're going to separate these. So quick recap on how we do this, all right? And remember, it's all about kind of practicing these and getting used to your method, okay? So we're going to go with the highest. We're going to go with the lowest. We're going to have our change. So what are my highest number of units? So as I come along here, I can see the highest number of units, 24,000, lowest number of units, 24,000, highest number, 36. So I'll have my 36 and I'll have my 24. What am I dealing with here? The units. Then I'm going to look at the relevant cost. So 36 and 24 have gone in, and then it's my production overheads I'm interested in. So 184,600 and 132,400. So 1846 and 1324. And you might notice that the numbers aren't as nice to deal with, okay? They're kind of bringing in the hundreds there now. Sometimes when it's left in thousands, it's a little bit easier to see it. So 184,600 and 132,400. And then how do I get my variable cost? So I'm going to take my total change all over change in units, all right? So total change 52. Number of units change 12. Then we're going to get our variable cost per unit. So €4.35, not as nice, you have a decimal in it, but still doable, okay? So €4.35, then we're going to look at the calculating our fixed element, okay? So we're going to go with our total cost minus my variable. And that's going to give me the fixed. So you can see pretty quickly, you'll get used to this though, you'll fly it in no time. So we're going to have 24,000, we're going to have, I should put units on it. And then we're going to take our 36,000. So for the 24,000 units, it was 132,400. For the 36, it was 184,600. How are we going to get the variable? We're going to say €4.35 multiplied by the 24,000. So 4.35 multiplied by 24,000. And then here, what am I going to do? 4.35 multiplied by 36,000. So again, just keeping it nice and simple, but you're putting in your notes for yourself each time. Now I know I'm moving through these fairly quickly, but you will be able to go back over it anyway. And just, I'll have to double check I don't make any mistakes when I'm flying through it. So 28,000, 28,000. And again, you're presenting that back for your examiner. So the variable. And then, cannot stress this enough, put the 435 per unit. They want you to illustrate that you know exactly what you're talking about there. And then 28,000. So that's part one. Part two. So we're going to do the exact same layout again, all right? And we're going to get it for our other overheads. So again, highest, lowest change. So we're going to have units, we're going to have cost. So 36,000, 24,000, and we know the change is 12. The cost associated then. So go back, make sure you're taking the right thing. 250,800 and 1692. So 250,800 and then 1692. And do double check those the way I was doing it there when you're in the exam. You don't want to lose marks on that, okay? So your variable cost per unit. So we'll have our change 81600 over 12,000. So €6.80, and then we're going to get the fixed element. So I'll just copy this down just to speed this up. So we come along there and we're saying, right, let's get the relevant costs in anyway. I don't have a problem. So total cost when we're talking about our lowest number was 169,200 and 250,800. The variable then, how are we getting that? The €6.80 times the 24,000. So we're taking 6.8, the variable cost per unit multiplied by the 24,000. So that was 6 there. And then here it was the €6.80 times 36,000. So 6 as well. So we know that we have those right anyway. So we have our variable, and it's coming in, and again, €6.80 per unit, and then the fixed. Just a straightforward 6,000. And you're showing your examiner, you have it presented nicely. Okay, so we have those done. Next thing, now obviously part 3 you'd have to do that, but just skipping to part B here, assume that Condon is currently operating at 100% capacity and is considering capital expenditure options costing 8,000. So we need to go and do this for 100% capacity. So 100%. Again, take your value here. So 60% is equal to 24,000. So 100%, how am I going to get that? Take your 24 and divide it by 0.6. So 40,000 units. Again, I need to have my direct materials and I need to have my direct wages or direct labor, it might be referred to as. So I'm going to use my first column. So 108 divided by 24. So 108,000 divided by 24,000 units will give me a per unit value there. So €4.50, and then do the same for your wages. So my wages figure 124,800 divided by 24,000. So 5.2. So for option 1 then, we're currently operating at 100% capacity and is considering 2 capital expenditure options costing 8,000 each as follows. So the modernization of machinery will save 60 cents per unit in the production overhead. So we're going to reduce our production overhead by 60 cents per unit. And then option 2, buying new machinery would increase the plant's capacity by 10%. So the units have changed while reducing all fixed overheads, including admin, by 8%. Prepare flexible budgets using marginal costing principles showing contributions for both options, taking the new cost structures into account, and advise the company. Right, so let's go through that. I think we still have time, okay? So option 1, our marginal statement, okay? So we are going to have our sales figure, then we're going to say less variable costs. Okay. Now, direct materials. How you spell direct materials. Direct wages, production overheads, and other overheads. So let's look at what's going to happen here. So my direct materials, okay, they are 450 per unit. Nothing has changed in option 1 for that. Okay, modernization will save 60 cent per unit in the production overheads, but currently operating at 100% capacity, considering 2 capital expenditure options costing 8,000 each as follows. Okay, so they are your capital expenditure items. Okay, you are going to spend that 8,000, so that is gone. All right, that is going to come out of there, no matter what happens. So what will the benefit be, I suppose, is what we need to look at. So modernization will save 60 cent per unit. So if we look, our variable costs, our direct materials will still be 4.5 by the number of units, which is 40,000 units. Direct wage is 5.2 by the 40,000 units. Production overhead, this is where it changes, okay? So my production overhead per unit, the variable cost per unit was 435. Now that's going to change. They are telling us that it's no longer going to be 435. It's going to be reduced by 60 cent, so minus 0.60. And then that's by 40,000. Other overheads, they haven't changed, so we're not going to just make any change to that. So we keep it as it is. So we're coming along and we're saying that's still €6.80 per unit. So that's going to be 6.8 by 40,000 euro. So as we come along then, we need to get those costs in. So 4.5 by 40,000 euro. We have our 5.2 by 40,000. So we have 435 minus the 0.6. So that gives me 375. So then 3.75 by 40,000 units. And then I have 680 by 40,000 units. So 272. So we have a total variable cost coming in there of 81,000. We will have a contribution figure in a second, and then less fixed costs. So in this particular one, my fixed costs, so my admin is coming in at 40,500. I have that capital expenditure, so that's sunk, that's gone, okay? So the capital expenditure is coming in at 8,000 there. Okay, and don't forget the production overheads and the other overheads. So the production overhead, the fixed element is still fixed, okay? That hasn't changed. So the reduction of 60 cent doesn't change the fact that the fixed element there was 28,000. So that's still 28,000. The other overhead then is still coming in at 6,000. So that will give you your total fixed then. So you'll have to do a little working then. So your total cost, we have our 810,000, sorry, plus 82,500. So the variable and the fixed. Now the reason you need that is because you want to work out what percentage that is. So go back to your question, and you can see in the question that the profit is budgeted to be 20% of sales. So if your profit is 20% of sales, that means your cost was at 80%. So the sales value is just going to be your 892,500 divided by 0.80. And you see, we need to have that sales figure in order to get our full contribution figure. So 111,565. And then we can come along and show what the contribution is. So by doing that, we're coming in with a profit there of 223,125. Now you're going to have to do the exact same for option 2 then. So if we look at option 2 and we check, what would that come in at there? All right, so I'm just conscious of time. So what I'm going to do is I'm going to have a quick look at the scheme, which is just to show you how this would be set up, all right? Okay, so we come back then. So just the change on that there, so see your 223,125 where we're coming in, all right? So option 1, we have our 180,000, our 208, our 150 and our 272, all right? And then production overheads 28,6 and 40,500. They're keeping the fixed cost separate to that. That's the 8,000 difference that we see here, okay? So our sales figures will be different there, the 111,565, all right? And I'll rewrite that for you in a second just to show you. And then you come along and you look at what your profit figure is going to be here with the changes that come in, okay? The 8,000 is sunk, okay? You have already spent that, all right? Now, in this particular scheme, what they've done is they've left the 8,000 out. So I'll just readjust this so as you can see, all right? So if we were to look at the way they've put it together on that one, okay? These stay the exact same, all right? But I don't want you looking back at a scheme and wondering, why have we got it done in a different format, okay? So what they've done is they've left out the 8,000 there, okay? So when they came down along, their total cost so it would be 810 and it's plus the 74. So and then we'd have our 884,500. So one, and then the 221125, okay? So there's your 221125. All right, just to show you how that's coming up on it, okay? Now, that actually brings up a kind of a good point here. What we do when we're producing our accounts, all right, because say the chief examiner can change and different things can change on it, we will always refer back to the most recent presentation in the marking schemes, all right? And we follow that when we produce the accounts, all right? The reason for that is that they do allow for variations on different things, but if we can follow exactly as they have done, we're generally in a better place, all right? So for your analysis on this, all right, what you'd look at is your overall profit figure. Now, because we were including the 8,000, they're both going to be down by the same proportional amount, okay? So the 221125 and the 246. So option 2 should be chosen, all right? And you have to make a statement on it. You can't just leave it hanging in the air, okay? You have to advise as to what they should do. Now, I'd go a little bit further and I'd say because of the profit that is made on it, all right? So just to recap on that, to get your marginal statement, all right, you had to increase it to 100%. That was a subtle change in it, okay? So you could have missed that easily enough and gone ahead with your 95% level of activity. So you just want to keep an eye there that you actually do answer what they're asking, okay? So they wanted it up to 100% capacity, and then, as I said, the 8,000 is gone. So it's like when when you in a marginal costing where you spend 8,000 on the advertising campaign, that increases your fixed cost, okay? But you can see in the scheme this particular year, they've gone with what I have on the right hand side there. So just to show you, they have left the 8,000 out of it. Key thing though is that it's the production overhead that was reduced. If you reduced any of the other ones, you wouldn't have got the marks for it, okay? You would have been penalized for it. So just keep an eye on that. Now what I'll do when I put up the videos on the platform for this, I'll highlight those over the different years where you had to be careful. So probably best to go with the format that they have presented in the scheme on this, okay? So this one that I'm highlighting here, all right? But your analysis is going to be the same. You're still going to come out with the correct option, okay? So that's it for this week, and keep the questions coming into me, and anything then that we need to run through, we will go through just as you come up with them, anything that you want to do. All right, so keep going on those, and if there is anything, as I said, make sure you give me a shout. Thanks.